Hi everyone and welcome back to the channel. Today I want to talk about mortgages, and that's because someone left a comment in one of my videos and wanted to know more about them. Number one, they wanted to know what the different options are, some information about down payments, and finally, what kind of rates you're going to see on mortgages really recently. So let's go ahead and get into it. First things first, let's talk about terms because that's the first thing your bank or realtor is going to want to know. And a term is really just a fancy word for years. So a 10 term is 10 years. So let's use them interchangeably from here on out. So some things to think about whenever you're looking at loans are the terms. And that is the different types of terms there are. There's a 30-year, 25, 20, and a 15. So when you go to the bank, you're going to say how long you want your mortgage to be for. And there's different advantages and disadvantages to all of these options. A 30-year gives you the longest time to pay it off. Your payment will be the smallest, but you're going to pay the most interest. A 15, you're going to pay that balance off quicker, but you're going to have a high payment due to it being a shorter amount of time. So think about that before you go in and start asking about what kind of loan you need for your house. So there's two different types of main loans, and we'll go over some other ones, but these are the main type. Number one, there's fixed, and number two, there's ARMs. So let's talk about both of those. A fixed loan is a loan that is going to have the interest at a consistent amount throughout the entirety of the term. So let's just say you have a 30-year term loan. Well, that means that your interest, let's just say 5%, is going to be 5% from day one until year 30 when the loan is finished. An ARM has a little bit of a difference. So let's talk about that. With an ARM, you're going to see different numbers. You're going to see like a 5-1 ARM, a 7-1 ARM, a 10-1 ARM. And those are just different options for how long that interest stays the same. So for example, a 5-1 ARM. A 5-1 ARM is going to have 5 years of the interest staying exactly the same, and then after that, it's going to float. And what do I mean by float? Well, when I say it's going to float, it's going to be based off of either the Wall Street Journal Prime. They used to use LIBOR, but they don't use that anymore. But usually you're going to see Wall Street Journal Prime or some other type of metric that is going to be determining what your interest rate is. You might even have a spread on top of that. So a spread is just a value that's assigned higher than what the actual base rate is. So for example, if you have a Wall Street Prime plus 0.25% spread, that means that if the Wall Street Journal Prime rate is 3% and your spread is 0.25%, your interest is going to be 3.25%. And that's what it's going to be until you either refinance or until that loan's finished. So make sure you're paying attention when you get an ARM. I know they're really popular right now because the interest rate's a little bit lower than a 30-year fixed, and people think they're really going to get into this and can refinance soon, but just make sure you're looking at all your options before you make your final decision. And the reason I say that is because if your rate does end up going up after your lock-in period is over, that means your payment's going to go up. So you might not be ready for that, so make sure you're prepared for whatever it's going to do. If rates are up, your payment's going up. If rates are down, payment's going to go down. So that could be a good thing, but I recommend trying to get in a new mortgage that will last you a longer period of time so you can have consistent payments and budget appropriately. So now we talked about terms and we talked about fixed and ARMs. Let's go ahead and talk about something else that's important, and that's the down payment you're going to have. This will be one of the main factors that determines your payment and is really a determining factor in what you're able to afford. So let's talk about something that people really misconceive about these, and that's that you have to have 20% down in order to get a mortgage. That's not true. That's not true at all. There's all kinds of different programs to make sure you don't need that. And there's even a thing called PMI, which is principal mortgage insurance, to make sure that you're able to afford a house for less than 20% down, but your payment might go up a little bit. So we'll talk about that here in a minute. First things first though, let's talk about conventional loans because I'm assuming that's what most people are going to be paying attention to. Conventional loans, you can go down to 5% down. And then after that, you're going to have a hard time getting a bank to really accept you, and they'll want to try and get an FHA loan on you. We'll talk about that next though. So conventional, you'll get between 5 and maybe 20% down, and that will be determining on what's available to you. You know, you got to consider more things like your emergency fund, your budget, and even just having enough money to pay the taxes whenever you first get this house. Something else that's really important to consider is if you want to pay PMI. PMI, as I said before, is principal mortgage insurance. And that's if you have less than 20% down on your house, you're going to have to pay that. The more you have as a down payment and the higher you can get that, you're going to have less of a PMI payment. But that'll be a factor in considering what your payment's going to be. If you have a really high debt to income ratio, that's also going to affect what your PMI might be. And even if your income isn't great, but your credit score is really good, that's going to affect it as well. So make sure you're looking at credit score and debt to income ratio along with your down payment in order to figure out what your PMI is going to be. One thing to note about a conventional loan and PMI is once you get that 80% loan to value, you don't have to keep paying that anymore. You'll be done with it and you'll be over. If your rate is really high, it's going to take longer to get there. But once you get to that 80% loan to value, you're not going to have to pay the PMI anymore. So remember that with conventional loans. Now, FHA loans are completely different. They're not even close to the same. So let's set some parameters on those. You can get up to 103% financed of your mortgage amount. Wow, that's crazy, right? No down payment. That's great. You want to hear another good thing about it? It doesn't matter really what your credit score is. As long as it's above 580, you can get an FHA loan. Your income has to be below $75,000 single, $150K combined. So there are some income parameters, but a lot of people meet those parameters, and it's really meant to help first-time home owners because that's what an FHA loan is. First-time home. So remember that. If you're not getting your first home, this is not your first buy, you cannot use FHA. Another good thing about FHA is you get to have a great interest rate. Doesn't matter that your credit score is bad. Doesn't matter that you don't have a big down payment. You get that great interest rate. Now, I just told you all great things about FHA. Let's talk about some of the negatives because it can't all be good, right? Well, with an FHA, you're going to see that you cannot get out of PMI. Unfortunately, after you get to that 80% loan to value, you cannot get out of that. And that's because you're seen as a high risk borrower. Even if you're not, even if you have great credit, even if you put a down payment, no, you're still seen as high risk because you're grouped in that FHA bundle. Another thing is your 20% you don't have to have, but it does help in order to make your payments smaller. One of the other terrible things about FHA is if your credit score is really good and that could really help your interest rate, it doesn't help here. Your credit score does not really matter as long as it's above 580, and you can't really help yourself with that. So if you have a really good credit score, it isn't really a blessing or, a big advantage compared to if you have a conventional or an ARM. And finally, guys, we have VA loans. I'm not going to go into deep detail about that because I don't know a ton about them because I'm not a veteran. VA loans are only for veterans. So if you've served in the military, National Guard, number one, thank you for your service. And number two, you get to be a part of the VA program. I know you get a really great rate. You do not have to have a big down payment. And I think you even get to miss out on PMI, but I'm not 100% sure on that. Go ahead and leave in the comments if you are a veteran. Go ahead and leave a comment what happens with VA loans, if you know anything about that. Happy to learn more about that and share that on the channel. So thank you in advance. Anyways, guys, the last point I want to talk about, and we've been talking about this a ton on the channel, is the interest rate. The interest rate affects you more than anything. You can have a really nice down payment, but if your interest rate's high, it's going to cancel that out and your payment's still going to be high. So make sure you're paying attention to interest rates. Can you afford what your interest rate is right now? Can you afford it for a while? Then there's an opportunity to refinance. You can take it, save some money, then start moving some budgeting around. But make sure you can afford the interest rate for the duration of how long you think it's going to last. Right now, it could be 2 or 3 years. Could be 5 years. We don't know. So make sure you can afford your payment and do not overbuy on a house. Anyways, guys, that's all I have for you today. Thanks so much for tuning into the channel. Make sure you hit that like and subscribe button, and I'll catch you in the next one.